Welcome, everyone. I'm Mike Brashazadeh.
And I'm Ashley Ward.
And you're listening to the What Matters podcast, and our mission
to spotlight top RIAs, wealth managers, and investment professionals who are redefining wealth management.
Join us as we dive into their journeys, strategies, and insights.
Whether you're an investor or an inspiring pro, this is for you.
Get ready for impactful conversations on the What Matters podcast. Hey, everyone. Welcome back to another exciting episode of the What Matters podcast. I'm your host, Mike Brashazadeh.
And I'm Ashley Ward.
Today, we're honored to have a special guest joining us, Steve Gattuso, Co-Chief Investment Officer and Senior Portfolio Manager at Courier Capital.
Stephen, with your extensive experience in investment management and academia, we're eager to hear insights into the industry and your journey. Thanks so much for joining us today.
Well, thank you for inviting me.
Well, let's dive right in. Stephen, let's start by exploring your journey in the investment world. Can you share with us your origin story and the experiences that led you now to your current role at Courier Capital?
Certainly. It started when I was very young, not to go back too far, but I bought my first stock when I was 10 years old. So I kind of knew what I wanted to do right from the get-go. And from there, went to university to take finance and accounting and everything that would prepare me for a career in the capital markets. Actually, I'd also taken computer science, and I remember some professors saying, "Oh, that's a great combination of computers and finance." And it was kind of quant before quant was really a thing. But I was fortunate enough to land a position at the 12th largest S&L at the time. And I was lucky enough to get a position as an equity portfolio manager in their buy right strategy. So that's what started me out on the path. And unfortunately, that bank was defunct as an S&L, so I had to leave the job I loved, and I went into a different finance role, which helped me as well with General Motors. So there was a financial analyst, which helped me from an analysis standpoint because I got to understand more the accounting side and more the valuation side, which is an experience you don't usually get as a finance person. And then I ended up back at in portfolio management with M&T Bank, and I've been here at Courier. I was them for several years when they merged with Wilmington. I moved on to Courier Capital here, where I am senior client-facing portfolio manager and co-CIO, which is a great combination because my background along the way, I did achieve my Chartered Financial Analyst designation as well as Certified Financial Planner. So I think the role kind of combines both sides of me, if you will, the analytical side as well as the people side.
Really cool. And so, go for it, Ashley. Sorry about that.
I was just saying, and so when was that you joined Courier?
Yeah.
I've been at Courier for 12 years now.
Very cool.
When did you become the co-CIO there?
Probably about 6 years ago, I was co-CIO. So I was the CIO, but then we've become so large. We're about $2.7 billion under management that we thought it was wise to kind of split up the duties a little bit. I have a couple analysts that report to us. So now that's why I'm taking CIO with the specialty. One of us does funds and ETFs, one does stocks, and we really do them together. It's just one leads that particular area.
And so if you could tell us a little bit about Courier. You've been there for, 12 years now. When you had joined the firm, what was the AUM when you joined the firm? You are 2.7 billion now. What type of growth has happened?
We were about 1.5 billion. And so it's grown pretty well, especially in the fact that we're in Western New York, which isn't a hotbed of growth, but we have been expanding with different offices. In fact, we're about to try to look at expanding in Florida, where I have a significant portion of my client base. And I think that's a growth market. So it's that type of organic growth along with some non-organic that really launched us to where we are today. And Courier itself actually has been around since 1967. So we've been here over 50 years.
Oh, wow. So the same owners still around there, or still in charge, or they kind of retired at this point?
No, there was about a fourth group of owners that at one point they decided to sell to a local community bank. So we're an affiliate of a local community bank. We're still an independent RIA. And it's kind of the way things are going in the industry right now. As you can imagine, there's a lot of roll up, a lot of consolidation that's been happening, especially in the RIA space. So we are part of that as well.
And so how much of your growth have you said was done inorganically as opposed to organically?
There were really only two kind of inorganic chunks, if you will, but the rest of it was organic. So I would say you're probably talking 60% organic, 40% non-organic.
And so how many total advisors now do you guys have?
Oh, we're up to about 10. We were pretty lean before that. When I started, we were only 12 people. We're upwards in the mid-20s right now. So it's been quite the growth from that perspective too, but I'd say 10 of our advisors.
Wow. And so would you guys say that the clients come through, word of mouth, getting more wallet share from existing clients? How have you guys been able to build over the last 12 years since you got there?
I'd say a few different ways. Word of mouth certainly is one thing where we do get a lot of referrals. We don't really do a lot of marketing, historically speaking. So it's not like you see commercials or advertisements from us. So it's been that type of organic growth where it's clients who have a favorable impression of us and tell other friends of theirs. In fact, I just got one this afternoon where it happened that way. So it's been that. It's been obviously wallet share of current clients as well when they consolidate, especially if they were pre-retirement going into retirement. The other thing that's been helping us too is some of the ancillary businesses that we do or lines of work, if you will. I do financial plans for my client that will also help with gathering assets. And there's also been 401k business that we've been in. So you do get some throw off from that as well. So I'd say it's not one silver bullet. There was just a lot of base hits instead of one home run.
I like that. I always say, my career has been mostly base hits. I might have gotten a couple doubles and, maybe made it to shortstop a couple times, but, base hits are always great.
Right.
So,
little higher percentage.
And so let me ask you this: when bringing on advisors, did you guys recruit from the wirehouses, or did you guys grow them organically? Out of college or what have you there?
Yeah, I'd say definitely the latter. Our culture is such that a wirehouse person might not fit. Just because with an RIA, we have a certain business model, and that might not appeal to a wirehouse person who's used to a different business model, especially when you're talking about payout, things like that. So we are a true RIA, and I always describe myself as a triple fiduciary because I work at an RIA, and then both my designations, CFA, CFP, would require me to be fiduciary as well. So again, it has to be the right fit. And one of the things I think when you're talking about growing it internally is that you can kind of mold that person so that they're used to working in this type of environment, not that they're comparing it to a prior environment they came from. It also probably helps that I teach at university level, so I have access to a lot of good talent in terms of analytical talent or students of mine who want to be advisors. So that probably helps as well.
Now, so you were saying that you teach?
I've been teaching for probably over 15 years now. And
Wow.
Yes, I teach finance. I was teaching it at one of the local universities, but then my alma mater, which is very close by to me, my old professors called me back to teach 12 years ago. And I teach investments course. I teach a financial planning course. But the biggest thing I teach is something called the Golden Griffin Fund, which is a student-run investment fund. It's about 20 years old. And I'm teaching them to be securities analysts. And it's been a very successful program. In fact, the CFA Institute Research Challenge team, which is it's a worldwide competition that starts locally, on equity analysis. And CFA Institute has about 1,000 schools that enter this competition every year. And it's kind of like the NCAA tournament where it starts out local and then you advance. The team that I advise comes from my Golden Griffin Fund, and the school is Canisius. And we've won the local every year for the past 14 years. And we won the global championship back in 2015. So again, these are analysts who are ready to hit the ground running in their career, and they're very interested in an analytical finance career. So it's a nice pipeline.
That's real cool. You kind of have a feeding ground for new talent.
Exactly. I said if I ever started a mutual fund, I know exactly where I'd get my analysts.
Nice. And so when growing these individuals or home growing them, have you guys had any challenges with some of these younger cats getting cute and maybe wanting to go start their own thing, or have you guys formed a nice way for them to earn equity throughout being there for years?
That's probably one of the things that we can offer. Now, we haven't run into that situation yet. We're kind of barbelled, where here in the firm we've got advisors that have been in the business for quite a long time, and we've got some new ones yet. So we haven't hit that mid-career advisor who says, okay, now I want something more. So that's a challenge we're probably going to have to face at some point, because we're a pretty flat organization, basically. There's the analytical side, there's the operations side, and there's the advisor side. But it's pretty flat. So that's something we're going to have to work on in terms of career progression. We're not like a large bank where you could move up the ranks, things like that. But I think that's the same with most RAAs.
Yeah. And we've seen lots of different strategies, but a majority is exactly what you're talking about. It's you haven't quite figured out how to do it, right?
Yeah. And I think one of the things that's going to attract the younger people, at least some of my students have gone this way, where they've joined an RIA because the principal is looking towards retirement, and it's kind of an overlap for, let's say 5 years or so. And then the principal advisor is going to retire, and the younger person's going to be taking over that line of business and that book of business. So I think they're staying because they see that happening. So I see that as well in the RIA world. That's where you're probably getting a lot of any stickiness, is the fact that they see that the assets will eventually transfer to them.
Gotcha. Mm-hmm.
Do you see, within your students, majority of your students say going to the big wirehouses versus going to a smaller independent shop?
Well, what's interesting about that, much like the rest of the investing world, or the investing public, I should say, there's really not a lot of understanding of the nuances of the industry. And I find that in the students too. Of course, they're younger, but they don't get what an RIA is versus a wirehouse. They don't get the broker side versus the fiduciary side. So I think part of that's an education where they're coming in, and especially if they're looking at several opportunities, they all kind of have the term financial advisor to them. So they're learning to distinguish, I want to do that or I want to do the other thing. So I think there's a little bit of learning process in there. And they also, since I teach in a program that's more analytical, geared towards CFA, and I also teach in a class that gears you more towards CFP, they don't even understand that difference quite yet. They're just starting to understand that, and that will help them to decide what way they want to go with their career. Because some might not want to do anything sales oriented, or some might not want to be just an analyst with a green eye shade, the typical picture right in a corner that no one talks to. So it's all dependent on what their personality is and what they like as to what direction they go. But at least if they learn the differences, then they can make an informed decision.
Right.
And building on that, I guess any advice you would have or lessons that you've learned out throughout your career that would be good advice for aspiring future financial professionals, future advisors, really looking to either navigate their way to where they want to go in the industry or make their mark in the industry?
Yes, exactly. I would say number one, do what you love. You got to have a passion for it, because any career path is going to be drudgery unless you really, really like it. So I think what I have found is high school students, when they enter college, don't really know what they want to major in because they don't understand the difference between accounting and finance and economics. But then college students who are seniors don't really know what to do with their career because they don't know how to apply it. So I think learning about the different career paths, understanding yourself in terms of what you like to do and what you don't like to do, is going to eventually lead you to where you want to go. Usually what I describe to students is, in this industry, think of it as a continuum. At the one extreme, you have the extreme analytical positions. Like I have students of mine that are equity analysts for the big firms, and that is a purely analytical job, and that's it. But then you got the other extreme where you have jobs that are completely sales and people oriented. And then there's a bunch of different career paths right in the middle, combining both. I mean, what I do, I see it as a combination of both. I have the analytical side of me, but then I talk to my clients every day too, and I have the people side of me. So understanding yourself and understanding how the industry kind of is set up will lead you to that career path as long as you know yourself, I think.
And let me ask you this.
Great advice.
So, with so many advisors being the average age around 60, retiring over the next 10 years, call it, it's always been, getting your degree, before going to a wirehouse or, joining a company like yours. Do you see that changing where they, the threshold will say these, some of these kids might graduate high school and there'd be a feeding ground in the future? Or do you see it strictly being like, okay, there's a degree that's needed?
No, I think it'll be a feeding ground. I just think there's an awareness issue where these students don't know what career path they can take. Like they don't know what a CFP is, right? So I think that's part of it too. They don't know. I have so many students that after they take my investments class, they'll come to me and say, can I do this for a career? Yes, you can. And you can do it in a number of different ways. So they're just starting to see that. But the other thing I think that's important these days, especially when you're talking about that succession planning and handing it over, I think culturally, we're so used to being buried in our phones, especially younger people, and so used to kind of that alone interaction. I think one of the things that's hardest to develop, and that's what I do for example, in that Golden Griffin Fund, I develop the soft skills just as much as the analytical skills, because it does me no good to do a great analysis if I can't articulate it to anybody. Right. So the public speaking, the one-on-one interaction with clients, the way to carry on a conversation and small talk and show genuine interest in a client, that's the piece that you don't get in a university. There's no course for that. So I think that's the biggest development piece that makes or breaks success for an advisor in going in this career path.
Yeah, I can see that. If they could have all the knowledge, right, but if they don't have proper communication skills, or they're introverted, talking to anybody is going to be a challenge.
Exactly.
Right? Yeah. And so you guys, when you're looking to hire any of these individuals, you'll spot where their talents are and say, kind of push them in that direction.
Yes, from a student side, when we're hiring, I want that combination, because you have to be able to talk to clients and you have to be able to understand what their challenges are. You have to show that genuine interest in the clients, because you're building a relationship. So I'm looking for the people skills as well as the analytical skills. The analytical skills you can get from your university, from your degree, right? Or even if you don't have them specifically, that can be taught. The people skills are a little bit harder.
Right.
Yeah, I'll share a quick story. Growing up, my father owned gas stations, so I had no desire to follow in the footsteps. I mean, obviously, my twin brother and I had to start working at the gas stations when we were in grade school. But I was like, yeah, there's no way I want to continue doing this. Had my father been, owned an RIA, I would have for sure followed in those footsteps, because this business has always intrigued me. This kid I knew growing up, he was a friend when we were in grade school, but as we got older, probably grew apart. His father was, owned a pretty successful RIA. I remember, the family had quite a bit of money. And he goes to Cal State Fullerton, and this kid was a big video gamer, right? and he graduates, and his father brings him into the business, hands him over about 300 million of AUM, right? Which I think at the time was, probably about a third of the book.
Okay.
And then, then the father, in short order hands him over, I think, another couple hundred million. And, and the kid didn't have quite the work ethic either.
Okay.
And, I took a look, and it's, on Discovery, and it's just been a downward slope, in a market that's been going up.
Right.
I think that they're at 370 million now. And so I was like, it's probably a good indication there that, they lost a lot of clients from that. Right.
Well, yeah. And it has to be done correctly as well in this industry, because I'll take the other side of it for a second. The client also has to do their homework. It's funny how in this industry, many consumers will hand over their money to people they hardly know or haven't asked any questions of. And I encourage anyone who comes to me, here are the questions you should be asking anybody you talk to. You can ask me and I'll answer them, but you should ask anyone else too. And it's funny how sometimes you have some clients that do more about asking about the qualifications of the doctor about to do their surgery, and they don't ask the same questions about the same depth of questions about people who are going to manage their life savings. So, in your situation, if it's being handed over, I want to know, if I'm the client, well, what is your son's background and how much experience does he have in this, and what's going to be the overlap? And I would want to know that as a client. So, I think it goes, there's some responsibility there too.
Yeah. I mean, I've had about a 3-month challenge right now with, with the firm that I'm with. And, I got passed off from the owner, and I've been passed off, twice now. The last individual, I've been de-risking over the last year, and, I was in 100% equities, and, I got whacked pretty hard in 2022. And, as the values came back, I started, de-risking to where I'm probably 65-35 now, or 70-30. And, the individual that they assigned me to had told me that my cash was going in the money market. And then I look, and they had it in a bank account getting 0.45% interest on it.
Right.
Right. And we're talking, quite a bit of money.
Oh, yeah.
And I told him, I gotta be made whole here. Right. And the thing was it happened to my twin brother as well. And that's how, we had figured it out. And so, I see where you're coming from with that. Yeah.
And I'll be honest, I think, in my experience, my teaching background helps me with my client relationship building, because in a way I'm educating them to the extent they want to be educated. Now, I'm not going to pontificate on something that's really technical and deep with a client who doesn't have that background. I tailor it to the level that they're interested in, but they have to be able to relate to the fact that this is what I'm doing with the portfolio and your money, and this is why. So you have to have that type of ability to explain where they get it. And I think what also goes with that too is, like I said before, it's a genuine interest in the clients. And many of my clients, I enjoy pretty much my entire client base. And there are several of them where when I get together with them, we'll sit at lunch for 2 hours, and there's probably a total of 15 to 20 minutes talking about the investment specifically, because it's about everything else. I mean, we're going over the portfolio, we're going over their goals and how it impacts the portfolio, but we'll also start talking about the different cars that they just bought or something like that, because I'm a car guy. So you got to be able to mix the two, and I think that's what builds the trust, and that's what's really key to this.
Yeah, I'm a car guy myself, so yeah. Recently, just to add in there, recently I've really gotten into those resto mods.
Okay.
I thought that those have been pretty neat, but yeah, really cool.
And so, Steve, let me ask you this: as a leader in your firm, in the classroom, how do you inspire and motivate your team, both in your professional environment and in the classroom, to really achieve their full potential?
Well, I think especially the younger people, I'll start there. Development is the key, right? So I don't want them to be stagnant. I want them to constantly be learning in things that they're interested in. It doesn't mean you have to go for a certification, but if you want to go that direction, that I would encourage that. So I think from that perspective, the younger people, that'll promote the growth for one thing. I mean, I still learn every day too. You never stop learning. I think also from the firm side of it, the motivation should come from that it should be self-motivation. You are dealing with people's livelihood and you're dealing with people's life savings. And no matter how much they have, whether it's a lot or a little, you treat that as every dollar they have. And you take it with that type of seriousness. And that's what motivates me, because I don't ever want to disappoint a client. That's the last thing I would want to do. Everyone makes mistakes, and I'm not saying that, but I'm just saying that you want to make sure you always got their best interest at heart in everything you do. So I think that's part of the motivation here too, is that people have trusted us with their life savings in many cases, and you should be doing the best job you can. With the student side of it, for them, the motivation might be a little bit different. It's not all about the grades. I'm here to teach you something. And I want you to make sure you learn that. And I want you to make sure you grow as an individual towards that career path that you want. That's what we're really talking about here, is moving to a career that you enjoy and is rewarding. So these are the tools I'm giving you to fill your toolbox to embark on that career. So that's kind of the motivation there too. It's not you got an A- and you should have got an A. It's, did you understand this concept, and do you understand why you might need it to help you in your career? Again, with that Golden Griffin Fund, they're very highly recruited because they produce paraprofessional-like equity reports. I've had Citibank and other investment banks say this is more than they would expect out of an undergrad finance major. So that's the key there. The motivation is when you start your career, you're going to be ready to hit the ground running.
Mm-hmm.
Yeah.
Very well said.
I like that. And so on that topic, what do you see for the future of Courier? Where do you guys plan to be in the next 5 to 10 years? At what size do you guys, is there a goal for the size you'd like to get the AUM to, or the amount of advisors, or geographically expanding there?
Yeah, if I back up for a moment and look at the industry, it's interesting how this industry is going. So you've got a lot of dynamics, a lot of moving parts, right? You've got fee compression. I think investment management is almost becoming a commoditized business. So in order to grow as a firm and to continue on, you have to be able to offer other services to those clients. And I think financial planning is one of those things. True comprehensive financial planning, I think, is part of that. So I think we need to build that out more. It can't be everything to everyone, but knowing what your core competency is and building around that, I think, is important. As far as an AUM goal, I wouldn't say we have one, but again, industry-wide, what you see happening is a lot of the roll-ups right now. You start an RIA and you're having several big firms just gobble everyone up. And it almost seems directionally the industry is going the way of, we were big wirehouses, then we went to RIAs, and the consolidation of the RIAs is turning us back into kinder, gentler wirehouses. So that's the way that industry is going. I think there's a certain value in the RIA being of a certain size so that the client is a name, not a number. Yeah. So as far as growth, I would want to see us expand those services that I'm talking about, the value add services that clients deem important. I don't have a target of the AUM that I think we should be. As long as we have enough capacity to treat the clients with the individual attention they deserve, then that will take care of itself.
I like that.
And looking ahead, what do you see as the future of financial planning, the future of the industry, the RIA space? Any trends, technologies, strategies that you really think are going to shape the future of the industry?
Well, in the end, I think at the core, this is always going to be a relationship business. And I don't think there's any technology that's going to replace that. There's going to be technology that uses tools to help you with that. I know there's a lot of discussion about AI and all the impact that has on different industries at this point. Well, maybe something like accounting, which is all rules based and you can program that, might be a little bit more at risk. But when you're talking about industries that need judgment and relationship management and no answer that's a perfectly right answer, that's always going to require human interaction. So I think things like AI and other technology tools will be used in the industry more, but I don't think it's going to replace this industry. I can't really see AI doing a financial plan because it's only as good as the rules programmed in it. And if you program everyone with the same inputs and the same rules, you can get the same answer. And there's got to be some nuances. There's got to be some alternatives presented. So that's what I mean about judgment. I do think that the industry is going to continue to consolidate. I do think there'll continue to be fee compression. But I think the firms that survive will be the ones that can give a value proposition to their client base beyond just pure investment management.
And why do you think it's going back to the way it was before?
Just because you have a lot of these larger roll-up firms buying small RIAs, especially people who haven't had a good succession plan over the last several years. So I just think you're getting these super RIAs that are getting bigger and bigger and bigger. And that's kind of replicating what we used to have.
Yeah. So instead of it being, some of the Merrill and Goldman, and you now have your Focus and Wags and those individuals. Yeah.
Yeah.
Yeah. Interesting. And so when taking a look at that, and when I did my research on Courier, it had shown that there was quite a big jump in AUM from 2023 to 2024. What took place there?
That was the consolidation. The bank had bought another RIA that was Rochester based, and they just consolidated them into Courier so that all the wealth management arm was under one umbrella.
Gotcha. So and so you guys are the. Are you guys independent of the bank, or
we are? We're just an affiliate of the bank. So basically, you can look at it as they own 100% of our stock, but we're still an independent RIA.
Gotcha.
Yeah.
Very cool. So then, when they, when they had brought the new team over, was the synergy there, and the core values, were they aligned with both teams?
We were already working with them. This was really just a change in name, if you will, for them to be Courier. So we were working with them already. They came from a little different spot, so we're still doing a little bit of meshing of things, but we were the larger of the two. So we'll probably be working with them to define the environment going forward, but it's not really too different from what we are right now. Gotcha. Just for example, and this was another thing I was going to say about the roll-ups too. When I was in banking as a portfolio manager, the client portfolio model, if you will, came from a central area and said we want all portfolios to look like this. Here, with a smaller RIA like this, where we do our own research, we determine what portfolios should look like for our clients, and we know the rationale, and we know what we're doing. We can explain it to a client. As you get to those bigger RIAs, it gets centralized again. So basically, a lot of the people dealing with the clients are just implementing what the home office says the portfolio should look like. There's a balance between efficiency and scale, and what's best for the client in terms of customization for them.
Yeah. So let me ask you this: when taking a look at the overall market right now, you know, where do you see, there's been, you know, 7, 8 stocks that are controlling, that are controlling the market, right? A lot of these AI stocks, lots of, there's still, sectors that are just completely, I think, being ignored. Do you see any, do you see, any areas that, you know, uh, that would be a good value right now that you would say, hey, you know what? I think that this is going to have a good uptick over the next 2 to 5 years.
I do. I think there's certain macro tailwinds that you follow. I mean, I'll use healthcare as an obvious example, right? It's the aging of the population, it's the innovation. Think about how fast we developed that COVID vaccine. So I think something like healthcare has a demographic tailwind, but it also has the innovation tailwind as well. So it's not tied to the business cycle. So something like that is, I think, has defensive properties to it and has growth properties to it. So I think something like healthcare has that. And I know right now there's a kind of a regulatory overhang on that industry right now, but that's not enough to offset those two huge tailwinds that I'm talking about. People want to live longer. People want to live healthier as they live longer. And that's, it's the innovation in healthcare that's going to allow that to happen. So I think that's a long-term value industry right there. And I do think, the concentration in certain sectors and especially, just a handful of stocks does create some issues. I mean, I know I have to explain it to clients where it's 7 stocks driving that S&P 500 return in the last few years. And when they ask, well, gee, how come I didn't get that in my equity portion of my portfolio? Well, because we have to run a diversified portfolio as fiduciaries, and I can't put all of your money in 7 stocks. I think one of the things that's a little concerning about that, because we've gone so much to the 401k as the primary retirement vehicle for people, and most of those are target date funds because companies have liability issues with them being fiduciary. I think you got so much being added to passive that it's like putting $1 on every horse in the race. You're going to get the winner, but you're also going to get a lot of the losers too. So there's not a true analysis of the economic value of a firm as there maybe used to be, just because passive is kind of controlling everything.
Yeah, gotcha. And so, do you think that where we stand going forward, right? We've had so much that's taken place with COVID. You have the 10-year going from 0.7 to up to 5% at one point. Is I think neutralized around 4% right now. With everything that's happened with the interest rates and the economy, how do you see this playing out over the next several years?
And it's funny you should ask that, because I do have a short-term and a long-term view of this, right? The short-term view is, yes, everyone's expecting rates to start coming down. There's no emergency here. There's no indication of no sign of a recession that's imminent. So I don't see the Fed doing anything more than 25 basis points at a time unless something unusual happens. But I think in this cycle, what I don't know is what the expectations of the market are. If people think we're going back to 2%, that's going to be hard, I think, to justify. So I think this cycle might include a rate decrease over the entire cycle that's less than what some people might be thinking. R star is talked about as something you can't observe, but the neutral rate isn't 0 anymore. And if we're at 5.5 right now, maybe you got 150 basis points of cutting to get to neutral instead of 500 basis points. So I think that's the short term. Long term, I think it's going to be driven by other factors. And a lot of that is, I think, debt, federal debt, government debt, deficits. We're not addressing that, and it's not sustainable. So right now, we're still doing 1.7 trillion in deficits, 35 trillion in debt altogether that we're financing at rates we haven't seen in years. So I think that's going to start to have an impact on growth a little bit, certainly government spending. And it's going to have an impact on interest rates in the future, because I think given the perceived risk, you might have buyers demand more reward to take on U.S. Treasury debt. And you've also got some technical factors where the big buyers, the Fed, Japan, China, they're out of the market right now. So you're depending on that retail buyer to buy all of this debt. And if you get into some situations where you don't have enough buyers for the amount of float that's going to be put out there to even roll the debt, that's going to create some interest rate issues going forward. So I expect rates, and basically through inflation, I think that's going to be higher over the longer term here, unless something's done to reverse this trend.
What do you think about housing prices?
I am concerned and waiting to see if this is a supply-driven issue or if it's something else. When interest rates come down, and given that a majority of homeowners who have a mortgage have a sub 4% mortgage,
right?
I don't think you're going to see them start to make a move until mortgage rates come down even more substantially than they are right now. You got to hit lower fives before maybe they start thinking about it. But once you hit that, if we do, it'll be interesting to see, because I'm thinking one of two things. Either all the pent-up demand for buying is going to be released, and since rates are low, all these buyers who couldn't afford are going to bid up the houses even more. So you could see in that case house prices going up even faster than they are right now. On the other hand, you also have a pent-up demand of people who want to downsize or move up in houses, and they're not doing it because they got a 3% mortgage right now and they're not moving to get a 6% mortgage. But once they say, yeah, I'm ready to pull the trigger, then you could also see a flood of homes come for sale, which would obviously lower prices. Mm-hmm. So I think, it's going to be one of those two things, and really can't tell you which. I lean more towards the house prices aren't going to come down, just because we're 5 million units short relative to population. And until those are built out, you're still going to be seeing people trying to buy houses. I just learned of one in my local area. The house was offered at like $500,000, and the bid went up to $900,000.
Really?
Yeah. I mean, that's unsustainable. Mm. But it's hollowing out the middle class. Pardon?
Was that pretty recently?
It was.
Yeah. Because what we see in our area, we're in Scottsdale, right? And the crazy part is, Paradise Valley would probably be, the place to live here, right?
Right.
The difference in home prices between Paradise Valley and being able to throw a rock to the ocean in Newport Beach or Laguna Beach is only around 30 or 35%, right?
Right.
And, I mean, to me, that just seems crazy, because when I first moved to Arizona 10 years ago, Newport Beach and, Emerald Bay prices in, the coastline of California, they were 2.5x what Paradise Valley was.
Right.
To now see that they're kind of in that same ballpark is it seems frothy.
Yes. Yeah. Right. Exactly. And yeah, I don't know. Obviously, income isn't keeping up with the ability to support that type of house price. So that's the breaking point, right? Where's the breaking point?
Yep. And do you think that the builders got so they got so much damage that they took 08, 09, 10, from having to recoup from that 05, 06, 07, all that building, all that surplus, that they're holding off on building all those extra homes?
That's exactly what I think happened. You were curtailing your building for 10 years, let's say, or more, so it didn't keep up the population. What will be interesting to see, because there's other times, it's always something you don't see, right? I mean, one thing that was postulated, which I could see happening, is you've got a commercial real estate issue in that no one's going to offices anymore. And you've also got some other commercial properties, whether it's retail or anything else, even churches, I've heard, being converted into apartments. maybe we become more of a renter nation like it is in Europe, right? They don't own their homes and they're fine with it. But I think maybe you see some of that start to relieve some of the pressure. And if you get that, then I could see home prices coming back down a bit. But, question is, you got two problems. What do you do with all this commercial real estate? And how do you fix the housing problem? Well, that might be one solution for both. Now, many of these commercial properties, it's hard to convert them to residential, HVAC issues and everything else. But there's still a shell of a building there. And these house prices continue to go up, makes that conversion a little bit more reasonable.
Mm.
Yeah. Well, and there's a tremendous expense involved too.
Yes.
Yeah.
Yeah.
I recently was approached, by these guys that they're running this alternative fund where they're buying AMC or Cinemax movie theaters and then converting them to they're called penthouse, a hotel penthouse type things,
Really?
right? Yeah, and they still have the big screen that drops down, right? But on the other side, they added windows and made them into these luxury,
Interesting.
penthouse.
Interesting. Yeah. Well, I mean, there's even things, like I said, we don't see where you just look at it and wonder what effect that has. Because I heard one of the presidential candidates talking about rent controls. If that happens, that changes the dynamic. So a lot of things that can impact this right now.
Mm-hmm.
Yep. Out of curiosity, do you guys have where you're at? Do you guys have an Airbnb issue where the neighbors have lobbied that and placed controls on people turning their homes into vacation homes?
Not yet. It's not loud yet.
Oh. Yeah, because I'll tell you here in Arizona, it got out of control about a year ago, right? I mean, it was there are people going in there and I know this one group bought 200 homes and they converted them to all vacation rentals,
right?
And and then they changed the rules on it, right? So
right,
it just takes a couple of bad things to happen, which took place.
Exactly.
Same thing that happened when I lived in San Francisco, and just was the same thing that happened here in Arizona. And now, they have to stay for a specified amount of time. And when you walk, I'll be walking my dogs, in the evening, and I see signs on people's lawns that say, we're a neighborhood, not a hotel. They're real anti-vacation rentals, and they
right.
have these signs on their lawns, just basically letting everybody know that.
Right.
So,
right.
Yeah. Well, it's interesting times ahead for sure, Steve. I think that wraps up our time together today, unfortunately, but thank you so much for joining us today. It's been an absolute pleasure having you on the show. We really appreciate you sharing your insights, your advice, your wealth of knowledge with us and our listeners. So thank you for joining us again, Steve.
Pleasure was mine. Thank you very much.
And to all our listeners, thanks for tuning in to another episode of the What Matters podcast. Stay tuned next time for more thought-provoking conversations. Until then, take care.